Based on the syllabus today, we are supposed to cover section 8.2, income tax. Let me get the note from the blackboard. Eight point two. And also, I'm getting the table note I made for this section. Income tax, this one. Hi, Emma. I was wondering if you received my email I sent you. Yes, I have received your email, and I forwarded it to another department. And oh, actually, I responded to your email. I responded already. I responded to your email this morning during my office hour. Okay, if you are late, remind me to update your attendance when we get closer to the end of the class. All right? Yeah, I'm gonna start the lecture now. This section we talk about income tax. Income tax. The first thing we want to know is how to find taxable income. You do not pay income tax on all your income. You do not pay income tax on all the money you make during an calendar year. You only pay tax on the taxable income. So the first thing today is to find taxable income. All right. Look at my note here. See, how do I make it bigger? It's the biggest. So firstly, we need to calculate the gross income. Gross here doesn't mean disgusting. Gross here means whole or total. All right. So let's take 2021 as example, because the book we are using is 2021 edition. The book is using 2021 as 2021 tax bracket as in the example. So let's take a 2021 as example. From January 1st to December 31st, 2021, every single dollar you make, add them all up. That is your gross income. All right. So first step is to find the gross income, and then you are going to find your AGI. AGI stands for gross income adjustment. AGI stands for adjusted gross income. My bad, sorry. AGI stands for adjusted gross income. It is the difference between gross income and adjustments. So you need to find out any adjustment that apply to you and then subtract those adjustments from your gross income to get AGI. Then what are adjustments? Look at my note here. I wish this is a touch screen. Let me see if I can save image as this one. Maybe this let me to, okay, this is better. Okay, very good. So adjustments, I have a list of adjustments here. Include tax deferred savings account, such as IRA, HSA. IRA here represents individual retirement account. Maybe some of you have IRA. It's a savings account you save for your retirement. HSA stands for Health Savings Account. And this type of account you save for your medical bills. If you put your money, if you put part of your income in those savings account, then you do not pay tax on those money. But later, for example, for IRA, when you decide to retire and you are allowed to withdraw money from the account, and you pay the tax on the amount you withdraw after you retire. So we assume for a person, a typical person, the person make more money before retirement and has less income after retirement. So the idea is, before your retirement, you make more money, so your tax bracket is higher. You're supposed to pay more tax on your income. But if you save your money in the retirement account, you do not pay income tax on the income until after you retire and withdraw the money. We assume at that time your income is lower, so your tax bracket is lower, your tax rate is lower, so you pay less tax on that. So that's the idea. So the money you put in the IRA or HSA, those savings plan, that is adjustment, all right? Adjustment also includes student loan interests, but there's a cap up to $2,500. And also, the adjustment is not your student loan. It's not the money you owe the lender. It's the student loan interests. Okay, only the interest part is adjustable and also has a cap $2,500. Adjustment also includes the educator expenses. As a teacher, if you are a teacher and over the year you spend some money buying tools or books for your job, right? Those money can be counted as adjustment, but there's a cap, no more than $250, not much. And alimony payment, like you divorced. Let's say you divorced and you have to pay your spouse money, right? And those is adjustable as well. And adjustment also includes self-employment expenses. So if you are self-employed and your name is not on the payroll of an employer, and your cases is more complicated, so you probably want to hire an accountant to do your tax because it's more complicated. But if you are self-employed, your self-employment expenses are counted as adjustments. So you should save the invoices or the receipt. If you put the gas in your car and you use your car for your business as a self-employer, right? Losses from a disaster, those are counted as adjustments as well, and more. I only have this many items that are adjustments. There are more, but we don't really need to know all of them. Those should be enough, okay? Just remember, those are adjustments. Everybody's situation is different, right? Maybe you only have a retirement account and you are not educator, or you do not have a student loan, right? Then you only have this adjustment. But if you are very young, you don't have any retirement account or house savings account, but you have a student loan, and your student loan interest would be an adjustment. So everybody is different. Look at your own situation. Once you find all the adjustment, you're gonna subtract those adjustments from the gross income. Then you get the AGI. AGI stands for adjusted gross income, and you do not pay tax on AGI either. You pay tax on taxable income. Now, how do we find the tax income? Once we have the AGI, we need to compare your standard deduction and your itemized deduction, whichever is higher, and you remove or subtract the deduction from AGI, then you have your taxable income. All right. Yeah, there's a lot of knowledge from this section. It takes understanding and memorize. So now you have AGI. Next step is we're gonna find your deduction. Find your deduction. There are two types of deduction: standard deduction and itemized deduction. Everybody in this country that they pay tax, they have the same amount of standard deduction. All right, standard deduction is given by determined by the government. In 2021, the standard deduction is $12,550. Every year is different. All right, I believe now is higher. Let's see, what's the standard deduction for 2024? Right now is the spring, beginning of 2025. The tax day is April 15. So before that, you need to file your tax. But the tax you file is for the previous year, 2024. So let's see what's the standard excuse me, deduction in 2024. In 2024, the standard deduction is 14,600. It is a lot higher, right, than 2021. Yeah. Also, if you are the head of household, the standard deduction is also higher. Suppose you have a dependent and you are single, you don't have a spouse. We'll talk about that later. Yeah, let's continue with this picture. So we have two types of deductions. Every year, every person, the standard deduction for that person is the same, is determined by the government. All right, is a certain amount. And itemized deduction is different, depends on the person. So what are counted as itemized deduction? Let's look at the list here. There are more, but those that I wrote here are enough for us. State and local taxes, those are itemized deduction. Home mortgage interest, if you are a homeowner and you pay mortgage every month, and the interest is counted as itemized deduction. Again, not the home mortgage, it's only home mortgage interest. Charitable contributions, if you donate a lot of money, right, over the year, then those money is deductible, itemized deductible. Rich people normally choose itemized deduction if they have a lot of donation, and itemized deduction is higher than standard deduction, so they choose itemized deduction. Besides those, medical and dental expenses that exceed 7.5% of AGI, those are itemized deductible as well. So we have a problem involve this information. So you want to take notes. Medical and dental expenses that exceed 7.5% of your AGI, that is deductible, itemized deductible. Also, casualty and theft losses, those are itemized deductible as well, and more. But the items I put here are enough for us. You cannot choose both standard deduction and itemized deduction. You can only choose one of them. You only have one option. Either choose standard deduction or itemized deduction. Since your taxable income is your AGI minus your deduction, you want to pick the deduction that has a higher amount. Normally, for regular people, the standard deduction is higher than itemized deduction. So far, I never do itemized deduction because it's very low. I always choose a standard deduction. But for rich people, they have a lot of itemized deductible items. For example, donations, right? Yeah, that's a very big one. And then they choose itemized deduction. So everybody is different. Important thing to know is you can only choose one of them. Okay, this one or this one, exclusive or. You cannot do both. So once you determine your deduction, you subtract your deduction from AGI. you have your taxable income. All right. So let's pause here. So the first thing we learned today is to find the taxable income. Yeah, that's how do we find the taxable income. The 3 steps. Find your gross income first, and then look at your adjustments. Subtract your adjustments from your gross income to get a adjusted gross income, which is AGI. Once you have your AGI, compare your standard deduction and itemized deduction, choose the higher one, and subtract the deduction from AGI. Then you get the taxable income. All right, so let's practice that. We do one thing at a time, okay? The first thing we do today is to find taxable income. Find the taxable income. Okay, let's look at Angelo. Angelo earned wages of $63,500, received $1,850 in interest from a savings account, received $15,000 in winnings on a television game show, and contributed $7,800 to a tax-deferred savings plan. He is entitled to a standard deduction of $12,550. The interest on his home mortgage was $6,500. He paid $2,100 in property taxes and $1,855 in state taxes, and he contributed $3,000 to charity. So that's all the information about Angelo. We want to find Angelo's taxable income, all right? But the problem breaks it down. We start from finding Angelo's gross income. Let's do that together, guys. Gross income include all the money Angelo have made over the year, okay? So let me highlight the information we have. So he has wages of $63,500. He has $1,850 in interest from a savings account. Even interest also you need to count it as a gross income. Even your tip, your cash from someone tip you, everything. Yeah, basically everything you have the money, all the money have come to you over the year. So those money are together is the gross income. So yeah, interest also have to be included for the gross income. And then 15,000, yeah, if you win a jackpot, you have to pay tax on that as well. That winnings also need to be counted. And contributed to $7,800 to a tax deferred savings plan. Okay, let me highlight this as pink. That is adjustment. Okay, that is adjustment. That is not his income. That's not his income. So we can pause here. Yeah, the rest of the information is related to his deduction. Yeah, we have all the information highlighted in blue to calculate Angelo's gross income. Gross income, GI, includes his salary, $63,500. Includes the interest he get from the investment or bank, right? $1,850. Also includes his winnings from the game show, $15,000. Okay, let's add those together. Let me get a scientific calculator. $63,500, $1,850, $15,000, 80350, 80350 dollars. Okay, so that is the gross income of Angelo. gross income. So far so good? Would you like to respond to this and let me know everything is fine? So far everything is clear, right guys? Okay, very good. Yeah, so we have the gross income. Next, we are going to find out the AGI of Angelo. Adjusted gross income, AGI. AGI. AGI is the difference between gross income and adjustment. So after we read through the given information, Angelo only has one adjustment. That is the money he put in a tax deferred savings plan. Tax deferred savings plan. Okay, that is an adjustment. So after I read the other information, that's the only adjustment. So AGI equals gross income minus adjustment. Gross income is 80,350. Use that to minus adjustment 7,800. Let's see what we have. On the calculator, we already have the gross income, right? Use that to minus the adjustment, which is $7,800. 72,550. 72,550. That is AGI. Okay? Yeah, we are making progress. That is AGI. And now step 3 is to find the taxable income. I'm going to put it here, all right? Taxable income is AGI minus deduction. What deduction should we choose for Angelo? Are we going to use standard deduction or his itemized deduction? And we need to know the values for both, and then we can compare, right? And we know the standard deduction is $12,550. I'm going to use yellow. Standard deduction is $12,550. And let's see Angelo's itemized deduction. So the interest on his home mortgage, this is itemized deductible. Property taxes, like local taxes, this is itemized deductible. $1,855 in state taxes, also itemized deductible. And charity contribution, also itemized deductible. Those items I had in green, those are Angelo's itemized deduction. Let's add them up. Let's add them up. Sorry, let me do this. Okay. Interest on his home mortgage, $6,500. $2,100 property taxes, $2,100. $1,855 state taxes, $1,855. And the charity contribution, $3,000. Okay, altogether that is $13,455. 13,455. 14. 13,455. This is the itemized deduction. Itemized deduction. And his standard deduction is $12,550. That's his standard deduction. Okay, guys, if you were Angelo, what do you choose? Are you gonna use standard deduction or itemized deduction? Cannot be both, by the way, to determine your taxable income. Yeah, exactly. Thank you, Charlie. Yeah, whichever is higher, right? Exactly. Thank you, Ashlyn. You're right. Itemized deduction is higher, so we're gonna use itemized deduction. The reason is because you want a taxable income as low as possible. I don't, yeah, as a normal person, okay, we want to pay less tax. So we want a taxable income as low as possible. So we want a deduction as high as possible. Then we can make AGI, subtract from AGI to make the difference small. So we choose the higher deduction. In this case, Angelo choose itemized deduction. Okay, so we have AGI, which is $72,550. Use that to minus itemized deduction, $13,455. Okay. AGI we got is 72,550. Use that to minus itemized deduction, 13,455. 59095. 59095. 59095. 590. 59,000. $59,095. All right. Do you see it, guys? Do you see how do we find the taxable income for a taxpayer? The 3 steps. Very good. Very good. That's the first thing we cover, okay? Yeah. Now you have the taxable income. You're gonna pay tax on the taxable income. How do you pay tax on the taxable income? Depends on the tax rate, right? I mean, how much you actually pay the government as the income tax. Depends on tax rate. And we have the table here. This is 2021. Yeah, we use 2021 as an example. Marginal tax rates and standard deductions. So once you have your taxable income, you need to look at the table here and find your category. Are you gonna file your tax as a single person, or married but separate, or married jointly, or as the head of a household? So there are 4 categories. Single. Single means never unmarried, divorced, or legally separated. Second category, married filing separately. You are legally married, but you decide to file the tax separately from your spouse. Why people do that? Because in some cases, for some people, the couple file separately. Together, they save money. Compare with they file married jointly. They pay less. Yeah, together they pay less tax. So that's the second category. The third category is married filing jointly. And then the last category is the head of household. Who is eligible to be a head of household? You have to be unmarried. You do not have a spouse, and you have a dependent. You have children or elders that depend on you. I think there's a more specific standard, like how much percent of your income have to support them. Yeah, here it says unmarried and paying more than half. Yeah, paying more than half the cost of supporting a child or a parent. So then you are eligible to be the head of a household. Yeah, the tax rate is different. Okay, let's look at the tax rate here. We have different tax rate and the tax bracket. You must have heard about tax bracket, right? How about let's use a single to be the as example. Other categories is similar. Let's use a single to understand the table. So the first tax bracket is in this column is 0 to 9950. This is the first bracket, okay? First bracket. And the second bracket is from 9951 to too small space. 9951 to 40,525. And the third bracket is 40,526 to 86,375. And so on, okay? We our questions probably only use the first three tax rates. So what happened is the first $9,950 you make, you pay 10% on those money. If you make more than that, and you pay 12%, 12% on the money exceed 9,950, but less than 40,525. If you make more than 40,525, your tax bracket actually is the third one, and you pay 22% on the money go beyond 40,525. Okay, I think the best way to really understand how would the tax rates apply on the taxable income is to look at a question. I'm going to show you how the tax rates apply to a taxpayer's taxable income through a problem. Okay, let's use this problem. How about that? Calculate the federal income tax owed by a person filing a return as a single, whose gross income adjustments, deductions, and credits are given below. Okay. Yeah, let's tackle this problem. And this person, this taxpayer, is filing his tax as a single. His gross income is $67,000. Adjustment is $9,000. Paid to tax deferred IRA retirement account. And he has deductions, itemized deductions, $7,500 for mortgage interest, $3,200 for property taxes, $5,450 for charitable contributions, $1,500 for medical expenses not covered by insurance. And his tax credit is $500. We are going to talk about tax credit later, okay? It's important, and it probably the best, one of the best thing in the world. But so far, let's not rush. Let's firstly find the taxable income for the person, okay? Yeah, we did it one time. Here, we're going to do it again. Gross income is 60. Let's just ignore the unit. They're all in dollars. 67,000. And the AGI, adjusted gross income, is we use the gross income to minus adjustment. He only has one adjustment. That is the money he put in the IRA, right? So minus 9,000. And the difference is 58,000. Yeah, 67 grand minus 9 grand, 67 minus 9, 58,000. Okay, if I calculate anything wrong, let me know. And taxable income. And we need to compare his standard deduction and itemized deduction. Standard deduction. His standard deduction is $12,550. You wonder, where do you get that? From this table, okay, from this table. As a single person, he filed as a single, right? His standard deduction is $12,550. That is determined by the government. So that's how do we know, all right? So that's his standard deduction. Let's see what's his itemized deduction. Itemized deduction. So itemized deduction has 7,500 plus 3,200. Mortgage interests, property taxes, charitable contributions, medical expenses go beyond 7.5% of AGI, right? Medical expenses not covered by insurance. Okay. Yeah, we do not rush. Let's take one to one at a time. 7,500, 3,200, $5,450. For the medical expenses, we have his AGI, right? We have his AGI. Let's see what is the 7.5% of his AGI. 7.5% times AGI. His AGI is 58,000. Not any medical expenses can be counted as itemized deduction. Only the part go beyond 7.5%. Only when the medical and the dental expenses go beyond 7.5% of the AGI, that can be deductible, right? So we have to see how much is that. Let's see. Calculator, 7.5%. 7.5% per divided by cent 100. 7.5%. And then multiplied by 58,000. 58,000. And we have 4,350. 4350. 4350. 4350. $4,350. Oh, oops. I mean, this person, this taxpayer, he can't, yeah, this $1,500 wouldn't work, right? The $1,500 is not deductible, is not itemized deductible. So we do not include the $1,500 in the itemized deduction. So let's see. The other three, yes, okay. Mortgage interest, the tax you pay, local and state, those are itemized deductible. So let's add those values together. Let's see how much is that. 7,500 plus 3,200 plus 5,450. 16,150. 16,150. 16,150. 16,150. Yeah, it's actually a lot, right? $16,150. That's his itemized deduction. Be very careful. People make mistake for the 1,500 medical expenses. Since that expenses does not go beyond 7.5% of the AGI, it is not itemized deductible. We do not include the 1,500 in the itemized deduction. So the first three, yes. So we got the itemized deduction is $16,150. Yeah, we know we're going to choose the one that is higher, right? The one that is with the bigger amount. So the taxable income here is use AGI 58,000 to minus this taxpayer going to use his itemized deduction because his itemized deduction is higher than standard deduction. His itemized deduction is $16,150. How did you know not to include the 1,500 medical expenses? That's a very good question. Let me show you the picture here. Let's see the itemized deduction. Yeah, besides state and local taxes, home mortgage interest, charitable contribution, medical and dental expenses that exceed 7.5% of AGI. Do you see that? Medical and dental expenses that exceed 7.5% of AGI. Okay, you're welcome. Yeah, since this taxpayer 7.5% of his AGI is $4,350, and his medical expenses out of his own pocket is only $1,500, is lower than 7.5% of AGI. So we do not count that as itemized deduction. That's a good question. All right, we were here. We decide to use the itemized deduction because it's higher than standard deduction. And then we do AGI 58,000 minus itemized deduction $16,150. 41850. 41850. 41850. So the taxable income $41,850. Okay, finally. This actually is the first thing we have already learned, right? Right now we are talking about the second thing. How do we calculate the tax amount, income tax amount that you're going to pay? How do we apply the tax rates on your taxable income? Yeah, since this person is single, file as a single, right? We only need this part. I'm going to just cut this part. Do it again. Okay. Oh, where's my note? Oh, here. Let's see if I can here. Make it smaller. All right, so let me try my best. I'll try my best to explain, okay? How do the tax rate apply on the taxable income of the taxpayer, $41,850? You know, we are going to convert that amount of money into single dollars. And right now we have, this is $1, right? Okay, another dollar, another dollar, another dollar, another dollar. We are going to put those $41,850 like this. Imagine you go to the bank and you give the bank a check, $41,850. You're gonna give me, can you convert those money to single dollars? And then the bank will give you $41,850. You know, the dollar, the coins, okay? And you have those dollars and you put them in a line, all right? This is how do you pay your tax. And you're gonna count from the first dollar, count until the $9,950, okay? Let's say you count the first dollar until the 9,000. This is $9,950, all right? Yeah, in other words, the first, yeah, you have those dollars in a line, right? Like that. The first you count the first $9,950. The first $9,950. You're gonna put those dollars in the first bucket. Okay, you're gonna put those dollars in the first bucket. In this bucket, you're gonna have $9,950 single dollars. All right, and then this is going to be the $9,951, right? Yeah, you're gonna count that dollars until the 40,000 $40,525. You see what I'm talking about? Yeah, why? Because your taxable income, 41,850, fall in the third tax bracket. Okay, this is the third tax bracket. Let me show you. I'm highlighting as yellow. The guy's taxable income is $41,850. It fell, his taxable income fell in the third tax bracket. So he's gonna have 3 tax rates apply. All right. So the first $9,950 going to the first bucket, and from the $9,951 until $40,525, how much money that is? Can you help me out? How much money that is? How much money that is? How do you know? Remember, this dollar, I'm using my big arrowhead, my mouse. This dollar is the $40,525, okay? And you already have $9,950 in the first bucket. So how much dollars that is? You use 40,525 to minus 9,950, right? So you use 40,525 to minus $9,950. 30575 30575 3075575. Do you have the same amount, guys? Those dollars you're gonna put those dollars in the second bucket. All right, you're gonna put those dollars in the second bucket. Be patient with me. Very good. Thank you, Jennifer. Is Ashland's those answers from before, right? 30,500, not 74. Oh, 75. It's because, yeah, do you understand why it's 75 and not 74? I subtract, no, you do not subtract that. You subtract 9,950. The reason is because this part, those are $9,950. You should subtract that amount. This $1, the $9,951 is gonna go to the second bucket. Let me know. Do you see the now? Do you see the now? Oh, okay, very good. Yeah, I wish would be easier if it's face to face. It's hard to just explain on the paper. So those amount of money gonna go inside the second bucket, all right? And you still have money left because you make more than the maximum of the second bracket, all right? The maximum of second bracket is 40,525. Okay, you make your taxable income. Your taxable income is $41,850, right? So the last dollar should be $41,850, right? Okay, tell me how much money you left, and then we can put those money in the third bucket. And this dollar This dollar would be 40,526. But you don't really use that. Just consider now you have those dollars in buckets already, all right? From $40,526 all the way to the last dollar, $41,850. How many dollars that is? How many dollars that is? Yeah, you're gonna use 41,850 to minus. You do not minus 40,526, okay? You minus 40,525. Do you have $1,325? Yeah, very good. Awesome. All right. Why do we do this? Because different bucket pay different tax rate. So now you bring your buckets to IRS, right? Internal Revenue Services. Yeah. So you bring your buckets. You take your bucket to the IRS, and the government gonna take 10% from your first bucket. Okay, 10% from the first bucket, and then take 12% from the second bucket, and then take 22% on the money in the third bucket, and those money together they take. That is your income tax. Okay, before the tax dollar, tax credit. Is that clear? Is it progressive? You do not pay one rate unless your taxable income is less than $9,950. It's by stage. All right? Does that make sense? Yeah. So I do meet people, they say, I don't want to find a job. If I find a job, I have to file tax, I have to pay tax. Well, I don't know what to say. If they don't find a job, how do they make a living, right? I guess I don't have the luxury. I want to make sure everybody is understand that, can understand that. So far, the idea how the tax how do the tax rates apply on your tax income? Let me repeat that, okay? Let me summarize. Depends on where your taxable income fall, which tax bracket your taxable income fall. In this case, the taxable income fall in the third bracket. The third bracket is from 40,526 to 86,375, right? That's the third bracket. And this guy's taxable income fall in the third bracket. That's the reason we know we're gonna have 3 buckets. We're gonna use 3 different rates. The first $9,950, we're gonna apply 10%, and the money go beyond 9,950, but less than $40,526. They put it in the second bucket, and the rest of the money put the third bucket, and they apply different rate. So now let's see how much money that is. So we're gonna use 10% to multiply by 9950. That's how much money the government take from the first bucket, right? And then plus 12% times $30,575. That's how much money the government taken from the second bucket. And then plus 22% times 1325. That's how much money the government take from the third bucket. Let's do the algebra. If you already have a TID for a calculator, you can try that. But if you don't, it's okay. You can work on it until next Wednesday. We would need that. Okay, you still have a week to get it ready. And 10% 10% of 9,950 is 995. And then 12%, if we only have a scientific calculator, we can do the job as well. 12%, 0.12 times $30,575. 3669. And then 22%, 0.22 times 1,325. 291.5. 291.5. And add those all together. 995 plus 3,669 plus 291.5. 4955.5. 49. Okay, so together the guy, after we apply the tax rates, his tax amount is $4,955.50 before the tax credit is applied. Tax credit is the last step, as I shown in my table note, right? Once you have your taxable income, you apply the rates, and the tax credit is the last step. Tax credit is the one of the best thing in the world, right? It's a $1 to $1 deduction from your tax payment. So what are counted as a tax credit? Child tax credit up to $2,000 per child under 17-year-old. I never had any tax credit until my baby girl were born end of 2023. So last year, 2024, when I filed tax for 2023, I was able to claim $2,000 tax credit. That's the first time. Yeah, tax credit is not that common. Adoption credit up to $14,300 per adopted child. That is a lot of money, right? Yeah, but do not adopt the children because of that. There's a lot of responsibility, and you have to put effort and love. Yeah, you're gonna adopt the children because of love, not because of saving tax. But you're gonna know, well, maybe I shouldn't have said that, but only in this country, probably most of the family that they can afford to adopt the children are doctors or lawyers when they have a lot of income, right? And they actually can take good care of those children at the same time get a tax credit. So win-win. I don't know if I should have said that. It's just my thinking. And also energy tax credits. If you use a solar panel or you purchased a new electronic vehicle, then they have tax credit. It depends on the brand, depends on the company, not all of them. Use the car, probably not. You have to check. So those are tax credit. Our taxpayer in this example, he has 500 tax credit. Yeah, and then we're gonna subtract the 500 from this amount. We have $44,455.50, and that is his tax amount. Okay, depends on if you are employed on the W-2. If you have W-2, means your employer withhold taxes every month, so they do not give you all the salary. They withhold the tax. So before the year ends, you actually already pay the tax. They take the for you. They already pay the for you to the government, and that's the reason you need to file the tax to see after you pay those things, are you owe or you can have something to return, right? If you over the year your withhold is more than this amount, you file the tax, the government refund you the extra money you pay, the extra tax you pay. That's still your money, by the way. Please do not allow anyone tell you that's the money government gave you. That's not the government gave you, okay? That's the money, that's the tax you pay more than you're supposed to, so the government refund to you, okay? You actually lost the interest on it. In other cases, if you do not have an employer with W-2, you have to manage to pay. It's more complicated than this course can handle. If you are self-employed, then it's more complicated, right? And we just focus on understand the most basic thing and do our problems. So this is the second thing. First thing, we learn how to find the taxable income. Second thing, we learn how to apply tax rates, income tax rates on the taxable income. And we also talked about the tax credit. Any questions, guys, so far? You have any questions so far? Am I clear about the buckets, you know? Yeah, I thought about it. How do I make it clear? I think the bucket would help you to understand. The face-to-face class, I would bring 3 cups with me and bring my coins with me. Okay, I'll put some coins in this cup and more coins in the second cup and the rest of coins in the third cup, and then show my students. That's how it works. The money in different cups, they have different tax rate. Okay, thank you, Ashlyn. Very good. All right, let's see other problems here. FICA. Okay, we also have to know FICA, not just the taxable, not just the income tax. Look at my picture here. So your income tax has 3 parts. First part is the federal income tax. What we have just talking about is the federal income tax. On top of that, you need to pay FICA. FICA stands for Federal Insurance Contributions Act. Those money goes to your Social Security and it goes to Medicare. I don't know if you recently listened to President Trump's announcement, like when he received the interview from the press, and Elon Musk discovered frauds. So a lot of people, the frauds in Social Security, and a lot of people, we have a lot of people over 100 years old. They're still getting money from Social Security, and a lot of people over 200 years old, and there's one person over 300 year old, and they're still getting money from Social Security. And yes, you have to pay FICA as well. And the bad news is the FICA tax rate applies on your gross income. Every dollar you make, including the tip, you pay FICA on it, not just the taxable income. All the money you put, yeah. So the FICA tax rate apply on your gross income. So when you need to consider your FICA, how much you pay FICA, you need to ask yourself: are you an employee? You have an employer, or you are self-employed? If you are self-employed, you have to pay yourself as employee and pay yourself as the employer. That's the reason, as you can see, the rates here, FICA rates, 15.3% is twice of 7.65%. You have to pay twice. You have to pay yourself as an employee, also pay yourself as an employer. But if you are an employee, your employer pay the 7.65%. You yourself pay 7.65%. Okay? All right, on the first $142,800. I believe majority of people don't have that much salary. If you can have half of the salary, probably thank God, right? Yeah, so if you make more than that, the rate is lower, is 1.45%. Is also go with bucket. Yeah, let me find a question that we can understand FICA better. By the way, besides the federal income tax and the FICA, you have to pay state income tax. Okay, state income tax. In the United States, there are a few states they do not have state income tax, including Florida. Yeah, we can do the research just a little bit. I couldn't remember all the states. I know Florida does. States that don't have state income tax. Yeah, the first one are Alaska, Florida, Nevada, South Dakota, Tennessee, Texas, Washington, and Wyoming. That's why a lot of people want to move to Florida, right? Not only good weather, but also free tax. There's no state income tax, but they still have to pay federal tax. They still have to pay federal income tax and the FICA. All right, let's find a problem regarding FICA. Here, if you are not self-employed and earn $180,000, what are your FICA taxes? Okay, so in this table, we have 3 columns, right? Yeah, this first column is employee's rate, if you are employed. And this is your employer pays. This is what a self-employed person pays. Since this person is not self-employed, we only need a first column, okay? We only need the first column. And the employer match whatever he pays. So we only need to look at the first column. FICA. In the table, we have 2 tax brackets, right? The first tax bracket from the first dollar to the $142,800. If you make more than that, yeah, from the $142,801 all the way to infinity, okay, if just more than that, you pay 1.45%, all right? So 2 buckets. And this taxpayer, not self-employed, so he paid this part, and his employer match whichever he pays. Then the money goes to Social Security and the Medicare. So his salary, this is gross income. We do not need to calculate taxable income because FICA rate applies to the gross income. Yeah, that's a lot. Let's find out how much is that. Since $180,000 fall in the second bracket, this person gonna have both rates, okay? Both rates. So we need to prepare 2 buckets for him. All right? 2 buckets. The first bucket pays 7.65%. Second bucket pays 1.45%. All right, the first bucket is the first $142,800. And the rest of money goes to the second bucket. Could you tell me how much money goes into the second bucket? He make $180,000, more than $142,800. So she put $142,800 in the first bucket, and the FICA going to take 7.65%, right? And the rest of his money goes to the second bucket. Can you help me to figure out how much that is? Let's see. Let me Let me see your answer first. 37,200. How do you get that? Yeah, seems right. 7,200. Okay, so we use 180,000 to minus 842,800. 002, 9 minus 2 is 7. 8 is 7. 7 minus 4 is 3. Do you mean 37,200? Did you mistype something? Do you mean 37,000? Yeah, okay, yeah, you did do 37,200. Awesome. Thank you, Ashlyn. That's correct. Awesome. Yeah. The rest of the money. So your gross income is 180 grand. You already have 142,800 in the first bucket. Then the rest of the money, of course, the amount is 180 grand minus 142,800, right? Yeah, that is 37,200. Very good, very good. And then the money in the first bucket, we apply 7.65%, multiplied by 142800. The money in the second bucket, we apply 1.45%, right? And 37,200. Yeah, let's use a scientific calculator. So far, where's my son? Here. 7.65% divided by 100%, right? And then multiply that by 142,800. Yeah. Let me see if I can copy paste here. Oh, yes. So it is $10,924.20. All right. Yeah, that's the FICA. That's how much money FICA takes from the first bucket. Let's do the second bucket. 1.45% divided by 100%, right? And multiply that by 37,200. $539.40. $539.40. And then we add them together. Let's add them together. We already have 5,539.4. Add that to 10,924.2. So the taxpayers FICA tax 11463.6. $11,463.60. That's a lot, right? You know, I want to know how many percent that is compared with his gross income. We're gonna use that. This is extra, by the way. For the purpose of the problem, we're done. I'm just curious, how many percent income goes to the FICA? Simply 11463.6 divided by 180. Well, this guy's salary is high though. 6%. 6% go to FICA, and also have to pay federal tax, income tax, state income tax. So tax is a very big deal in our financial life. Is that clear, guys? Am I clear about how does FICA work? Okay, very good. And we have 4 minutes. We can look at probably another. This one is too long. I think we covered everything that we needed. One more thing is, what if you are self-employed? If you are self-employed, you're going to look at this column, okay? Your tax rate would be different. Your tax rate, FICA rate would just be doubled. And that's the only difference. So reading information provided by the problem is important. I was late to class. Can you adjust that? Okay. Yeah, let's go to which section number though? Do you remember which section? Are you 903 or 904? Let's try 904. Jennifer. Yeah, anybody else? Please let me know. Anybody else missed the roll call? Charlie? Okay. All right. Just know being late does compromise your attendance score. You're welcome. You're welcome. Thank you for coming. And that's everything for today. Essential class, I'll see you in 10. And the other section, I'll see you on Monday. Yeah, feel free to email me if you have any questions. Thank you. Bye-bye. See you later. You're welcome.